All right, good afternoon, traders and investors. Hope everyone's doing well. Markets are getting a little bit trickier again after having that massive rally in, in October. So what we're going to talk about today, I think, is going to be very enlightening. We're going to talk about how we can profit from a new market environment. In other words, how we can profit from a shift in market environment. And a lot of people tend to think that it's actually quite obvious when a market shifts environments, but as you will see, there are quite a few things we need to look at, but the good thing is it's only those things that matter. So my presentation today is going to be very to the point, and I think you're going to get a ton out of this. This is stuff that I discuss with hedge fund managers and institutional investors on a daily basis. So this isn't stuff that I just kind of dartboarded around on some charts. This is stuff that I think for the most part that should matter to most investors. And we're going to go through some strategies how we can actually make money in this environment. So without further ado, let's get going. And I'm trying out this new presentation software by Google because my PowerPoint continues to have problems. So hope this is going to work out. For those that don't know me as well yet, I am a big fan of keeping it simple. Okay, when it comes to trading and investing, I think the finance industry has made this business much more difficult than it needs to be because it's already challenging enough as it is. But if we keep it simple, I think, and I've learned this over the past nearly 20 years as an active investor and trader, that the simpler we can get it with a set of strict rules, but knowing what to look for, the better. The odds are of successfully pulling out money on a consistent basis on a year-over-year basis. So keeping it simple, you got to focus on what matters. The charts we're going to look at today and the things we're going to discuss over the next 35, 40 minutes are going to be things that are really important and they matter. Okay, I'm not going to give you stuff that is just stuff to fill up the air on a TV station or something like that, which unfortunately is the reality with a lot of financial media is they need to cover stuff to pay the bills so we can sell advertisements. And so we need to focus on what matters. And quite frankly, at the end of the day, we need to focus on risk management. And we'll talk about that after I give you some big picture overview. So let's get started with the big picture stuff so you guys understand kind of where we are and how we can detect these shifts in market environments. So markets tend to change, but what does that actually mean? So markets are constantly in a sea of change. The only constant in markets is that that they constantly change. That's the only thing that is the same all the time. They change, right? So history rarely, if ever, repeats itself in the markets, but it often rhymes. And you will see this, and that's a really important point to when we try to detect when markets shift environments. So instead of risking to fight a market and unnecessarily sort of fight the uphill battle, we need to be able to detect pretty quickly when a market is changing or is going to change, or if we're a little bit late, make sure we realize that really quickly. And again, through looking at a few things, we have a great chance of getting that right. So there are a few things to watch, and really the rest is noise. Quick word on volatility. Volatility is a part of a shifting market environment, whether that's at the top of a market or at the bottom of a market. So whether we're going from a bull market to a bear market or from a bear market to a bull market. Okay, volatility is a part of that transition, and it happens slowly and then it all comes at once. And we've had, of course, precedents here in August and September of that taking place. Volatility always returns. It's completely normal. Volatility is a mean reverting thing, historic volatility and implied volatility. So it only freaks out the people that are not prepared and are kind of narrow-minded and think they know everything, because the market is the biggest equalizer there is out there. So we have to respect that, but we shouldn't fear it. We're going to skip this slide. It's not so important. So let's start with the first slide here. And if you guys are following me on Twitter, or if you are a subscriber of any of the products and things that I have, then you may have seen this chart. What you may have not seen of this chart is the latest updated version. So this is, if we look at this chart, this is in blue, we have the S&P 500. In red, we have the VIX, which is the implied volatility of the S&P 500 options, right? Now, we had this sort of crocodile formation taking place from October 2014 all the way to August of this year. And I highlighted this all year. I said this is not something that's going to mean revert immediately, but ultimately it always mean reverts. And boy, did it mean revert here in August. Look at how volatility spiked and the market fell. Now, since the October rally, we're once again having this sort of crocodile, this hungry crocodile take place where the S&P is riding like crazy and the VIX is falling, which is a normal thing to happen. But a lot of times it overdoes it and there's a mean reversion move that needs to take place. So for example, look at what happened here. This is October 2014, big initial rally in the S&P, big drop in the VIX and implied volatility, makes sense. But there was a snapback reaction. And this is what I, in the immediate term, fear or think is going to take place. And we will see this in just a minute. So the S&P 500 here, if you look at it through a 12-month lens, you know what, guys? Nothing happened. Okay, if you literally fell asleep in early October or say mid-October of 2014 and you just woke up like a couple weeks or like a week and a half ago, you would say, okay, well, nothing happened, right? And the crazy thing is, for the most part, that's true. Nothing really happened for the most part of that. And that's a big part of what I want to talk to you about it, guys. The only thing we had is a massive correction, a very swift, like a 1 week sell-off in August, then some chop, and then a rally back up. But if you look at the majority of the price action over the past 12 months, it has taken place somewhere between, let's call it 2050 and 2150. Okay, that's the majority of the price action. So basically, the market has sort of consolidated, right? And right now we're at historically overbought levels in the S&P 500 from a momentum perspective. And so this is not something you want to chase higher here in the immediate term. Doesn't mean it can't go a little bit higher into year end or something like that, but this is something you want to be a little bit cautious of. Okay. The point is, a market in transition has this kind of a feel. We've spent a lot of time up here. We didn't break out above it. We then had a big nasty correction, and volatility came into this market. We had a first volatility scare here in 2014, the first one since 2013, right? We then had this reaction higher, and now we had after a very muted, long, boring year, we finally had that correction. So this is the initial sprouts of volatility that we're seeing, and tops in markets tend to take place. They don't occur in 1 week. They tend to be processes. They're not events, right? So we need to give this stuff time. But if you think you need to chase stocks higher at this point in a 6-7 year bull market, you are probably a little bit late to the party. I'm still very bullish from a secular perspective for this market, but I really think here from a cyclical perspective, things are getting very, very long in a tooth. Again, doesn't mean we can't trick a little bit higher, but for the most part here, I think a lot of this is probably over. So that's one tell. The other tell, guys, I call it the three horsemen. There are three horsemen for me, at least for a good part of this year, were Facebook, Amazon, and Google. Each one of these stocks is materially higher year to date. Each one of these stocks, after already having a steep slope, has taken their respective slopes vertical, literally vertical. You can see these three stocks represented by purple, yellow, and blue. Purple being Amazon, and then I guess Google and Facebook are one of these. I don't know which ones they are. It doesn't matter. The point is, these stocks have taken steep slopes and taken them vertical. And that is not exactly something you want to see, particularly for three very important, very heavy market cap stocks. I'm a believer in all these three companies, by the way. I think they're going to continue to grow in the future, but they're being chased by every single fund manager out there that's been lacking performance, and that's most of them. Okay, that's a dangerous thing to happen, and that tends to happen towards year end. But the way it's happening this year, this is a cyclical end of a cyclical market type of chase that's happening here. Okay, so that's clue number one. We have volatility spiking, and then we have these kind of big three horsemen going vertical. Large caps tend to be leaders towards the end of a bull market, right? That's another thing. Let's look at this chart. This is probably the most telling chart that I'm gonna give you tonight, and it's one I've kind of shopped around TV and radio and seminars over the past few weeks. And what you have here in blue is the S&P 500 as we all know it, right? Market cap weighted index. What you have in red is the ratio, okay? The ratio of the equal weight S&P 500, where each stock is weighted equally, versus the S&P 500. In other words, what the red line is telling you is that this market rally that took place in October and into early November has basically been led by a few really heavy weighted stocks, basically the ones I just told you before and a few more. Okay, that is not healthy. Take another step back. If you look at when this ratio topped out, it was in early 2015. I guess it was like in March or May or April and something like that. It looks like that's when that has topped out. Ever since then, this ratio has been making lower highs. In other words, market breadth has continually worsened ever since early to the springtime this year in the S&P 500. This is a seriously crucial chart, and this is one of the major things you want to look at when you see markets trying to change stance, right? And again, it's a process. Look at the S&P 500 itself. It continues to sort of trickle around its highs, but equal weight S&P 500 on a ratio basis versus the S&P has been falling dramatically. Okay, that's really important to keep in mind. You can take this another step further and look at retail stocks. Look at Macy's and Walmart and some of those guys, but other stuff as well. They're not exactly loving this. Look at the red line. That's what they're representing, the retailers. They're not liking that. They're totally diverging from the S&P 500 as well, right? And they tagged along with the S&P quite nicely, but this latest rebound here, they just haven't participated. In fact, they've totally diverged from it over the past couple of weeks. Okay, again, this is important because it's telling us that the retailers and the economy itself may not be as good as some people think. Okay, again, another point that I think is something to be careful to be carefully watching, because it does, in my opinion, tell us that the market environment probably already has shifted. High yield. I cut my teeth in investment banking world in my career at JP Morgan in the fixed income department, so I'm quite privy to high yield. And high yield basically tends to be leading equities. Not always, but for the most part, high yield tends to lead the market. What it's doing now, and it's the red line, is completely lagging this rally, and it's been lagging it for some time. But again, once we had this, that's why the August volatility was so important, because it was the initial shakeout. We're now having a rebound, but we're having a rebound in a few stocks. Okay, and while market breadth could certainly improve again a little bit, I think the divergences at this point are so severe that it's really difficult to see the broader market catch up, if you will, to the S&P 500 itself, i.e. to the rest of those few stocks and to some more that I talked about before. Okay, let's look at the dollar. Okay, if you guys are not following the dollar index, I would strongly urge you to get an understanding of what the dollar index is and does. Basically, a basket of the dollar versus a whole bunch of currencies, right? There's several dollar indices. This is the major one that I tend to look at. This goes versus some European and other currencies. Then there's also an Asian version, okay? But the dollar index has basically rallied very strongly last year, then consolidated for the most part this year, but just recently, basically last week, broke higher out of this technically bullish formation, okay? What that is, guys, it's deflationary. And deflationary environment is not exactly bullish for equities through the medium-term lens. Okay, that's another important thing to keep in mind. It's also not important for emerging markets, by the way, and other things. So we can then look at the 10-year Treasury note yield, okay, which is here trying to stage a breakout. This is yield of the 10-year note, right? Currently around 2.3-ish%, 2.33. That's important to note, because if yields go higher, that's, not exactly what you want to see at this point in the cycle, where we're having decelerating economic growth, Okay, so just one more thing to keep in mind. What are yields doing? And yields are more tricky because they tend to do different things at different parts of the cycle and in different cycles. But keep an eye out. I think this, if we see a meaningful spike higher above 2.5 or so, that's probably going to be one more thing that's not going to be very good for equities. Again, a shift in environment. Look how long the yields have been consolidating and haven't really had a meaningful breakout rally now for nearly 2 years. That's also signaling a potential shift in the market environment. Another one, and this is a little bit more fixed income institutionally, so if you want to just close your eyes for a minute, that's okay. But it's an important thing as well. So what you have here in blue is the same chart I just showed you. It's the 10-year yield, okay? What you have in red is inflation expectations as represented by TIPS, Treasury Inflation Protected Securities. You would think that when bond yields rise, it's because inflation expectations or inflation is rising. Not so, and it's certainly not in this cycle, right? In this cycle, you see inflation expectations actually coming down, which is telling you that this market and economic growth is not where people think it is. Okay, bond yields are rising there's different reasons for that. The question is how much longer can they rise? I tend to think although they may be rising, they're probably going to be capped there very soon. But the point is inflation expectations are not rising with bond yields. They're telling us that economic growth is not what it should be or looks to be. Okay, and that's a hugely telling sign. It's been making lower highs, by the way, since 2013. Okay, another little hint there. After ramping higher, I'm talking about the red line. Okay, hope you guys are seeing this is really, really, really good stuff. Next, we can look at commodity or oil volatility, right? Volatility in oil is just a direct reflection of the drop in oil price has been spiking for the past, let's call it year and a half or so. Okay, that's also not exactly a wonderful thing for equities, and it does tell us we're shifting into a new environment. Commodity volatility tends to precede equity volatility, and they can take 12 months for that to finally hit equities, as it just about did this time around. But it's an important thing to note. Currency volatility as well. Look at that, same thing. Started spiking. This is a little bit earlier, but yeah, let me see here. Well, I'll get to the questions shortly, guys, once we're through the meat of the presentation. But type them in if you'd like. No problem. So what's the strategy? You guys are saying, okay, you're probably sitting there saying, okay, that's nice, Serge, but like, all these charts, what am I to do? Well, what I can tell you is that we are most likely, just quickly going back to the S&P 500 chart, we are most likely going to have an environment now that is no longer just a constant constant climb, but it's going to be a much more volatile, I would call it choppy. Okay, what that means is we can't just blindly buy the dip, but we have to be a little bit more active and a little bit more tactical. That doesn't mean we have to be nervously day trading. Not at all. We don't have to day trade. We have to just take positions, understand what they're doing, have our risk parameters, and get out. Because we can't expect markets to just continue to inflate for 7 years or 6 years in a row without any more, at least a 12 or so month period of a little bit more volatility. So that's where we are. So if I go to the next chart of the S&P 500, which I have for you guys here. So again, to recap, be tactical, buy the dips, sell the rips. That's what we need to do. And again, I'm not calling you to be actively trading too much, but we have to understand that this is a market that that has to be a little bit more actively managed. You can't just if you blindly buy something, if you go in and blindly buy a mutual fund right now and say just because you have to allocate capital, you're not going to look very good over the next 12 months. I can promise you that. Okay, and even if it takes a little bit longer or it goes a little sooner, I don't know. But the point is, right now is a market that is shifting. Okay, so correlation tends to increase, but it then also breaks down. So if you look at this year, for example, you just look at a couple of stocks. Look at something like Amazon, and then look at something like Macy's. There's two retailers, and there's other reasons why they're diverging, right? Right? There's other reasons why they're diverging that are structural in nature of retailers, but that's where correlation tends to break down. Okay, so that's the tricky part about these. When the environments shift, you have correlation will increase among most stocks and sectors, but you'll also in some cases have massive divergences, which is to say that we have to be more tactical. Because if we're not tactical and we just assume that everything's going to float up together, we're really going to get stung. Okay? So we need to focus on indices, ETFs, higher beta stocks, maybe a little bit less on special situations, and a little bit less on sort of smaller cap stocks, although you can of course play them with ETFs. The chart I wanted to show you here is the S&P 500 going back to the 2011 lows. All right. What you have here is a very simple chart that shows you how systematic the rally has been since 2011. This is after the reflex rally off 2009 lows have taken place. We constantly stair-stepped higher every single dip, and I mean every single dip. Every single dip was bought until this August, where yes, that dip again was bought, but so far we are kissing right back up to that lower resistance line. Even if we go higher, guys, this change of trend or the break of this line is not something that's going to resolve itself in just a couple months. This, in my experience and in my understanding of history and all that I've done this for nearly 20 years, I can tell you this is something that's going to last longer than a few months. We're not going to scream higher towards 2,500 in the S&P anytime soon. We need to chew through, and it's going to mean that the environment's going to remain more volatile, and we need to adapt to that, and we need to be tactical. So what does that mean? So you need to understand something called confluence zones. You need to understand that in this market, you can profit hand over fist if you understand what a confluence zone is. So you need to understand some textbook, you have to have a textbook knowledge of some of these basic technical analysis things, but you need to use the real world version. And I'm going to give you a couple of examples of the real world version right now. That's a mouthful, actually. Say that 4 times in a row. The real world version. Okay? So let's look at a few examples here. I'm going to quickly zoom out of this thing here and get you right to the charts. So these are some real trades I've done recently, and I'll show you here how these confluence zones work just absolutely wonderfully in this environment. So let's look at the energy sector, for example. I'm going to take the XLE, which is an ETF that represents the S&P 500 energy sector. What you can do with just using some very simple moving averages is look where multiple things come together. Okay, so let's look at, for example, the most recent trade that I've done in the energy sector. We take a very simple oscillator, something called the MACD, very simple. Everyone has this thing. Just go to your oscillator thing, click MACD, and look at what happened most recently. So this is where the market sort of swan dived into the late August lows. We then had a near record oversold reading in this indicator. We then bounced, made a higher low in September along with the broader market, and then had a very crucial bullish reversal outside day, which is this day right here, which confirmed to us two things. It confirmed a higher low versus the August lows. It also confirmed to us that this MACD reading was severe enough to now give us a bounce. What I did, I bought the XLE at the end of this day right here, and we had a really nice rally higher. Okay, I hope you guys can see that work. So what we're having is a confluence support area. Confluence support meaning made up of several things. One, it's made up of the deeply oversold MACD, right? A higher low versus the August lows, and a bullish reversal day. Very simple stuff, guys, but this is the kind of stuff you really have to focus on in this kind of a market for the next probably 12 months or so, because it's no longer blindly buy the dip. You've seen this. The market has definitely changed. All the charts that I showed you for the past 25 minutes or so, or 20 minutes or 20, they're clearly indicate that we're moving into a new environment. In the new environment, you can't just blindly buy the dip. You have to look for several things and can get more confirmation than you otherwise would, because the trend now, even though the trend might be up for another 10 years, it's going to get choppy for some time. So confluence, example number one, the XLE. Next example, let's look at Facebook. Facebook, another trade I did here, we used the 200-day moving average, which is the red line. Let me quickly get rid of a couple things here because I don't want to confuse you with all these drawings and things here. So we're using the 200-day moving average, which in this case is the red line. If you zoom back far enough, you can see that that 200-day moving average, let's let it catch up. That 200-day moving average has been holding as support for Facebook since it gapped higher here in the summer of 2013. Look what it did this August at the August lows. The broader market fell apart, so did Facebook. That's to be expected. People take profits, they sell some of their winners. Facebook certainly was one stock where they had enough profits to do so. So Facebook dropped below this 200-day moving average for the first time in a couple years. But guess what? It didn't do so on a daily closing basis. This is all intraday on this one day, which was August 24th. We broke down, but we rallied back so severely intraday, we actually ended up holding it. That is very bullish, particularly if this is being followed by another confirmation rally day. Okay, so what you have is a confluence zone made up of a couple things. A, the 200-day moving average, and B, a bullish, very, very bullish reversals given us by the candles. Okay, you can see we had this signaling candle, then we had a confirmation rally day, arguably the next day, but that closed on the lows. But the third day, we had a real strong rally that then allowed me to get long Facebook and have a really, really nice trade here into the low 90s. Okay, just a couple things to look for. We had a wonderfully high probability trade in Facebook. Let's look at Goldman Sachs. We're looking at here, the confluence zone is made up of also a bullish reversal, and again, the MACD. Very, very simple stuff, but if we know what to look for, this is stuff you're going to be able to do all day, all week, all month in the market that we're going to have, I suspect, for the next 12 months or so. So what we're having here in Goldman Sachs is very much like the broader market, and as you just saw on Facebook as well, we had a stock that essentially dropped quite severely in August, made a certain low here with the broader market, but then actually in September undercut this low. As you can see, it made a lower low in September. MACD was historically oversold, but on a daily closing basis, guys, and this is why it's so important, we had a confluence support area that stretched back quite a bit. In fact, stretched back arguably all the way back to October 2014. Okay, so we had a lower low that quickly gave us a bullish reversal 2 days after with a big outside day. I'll show you this right here. So we have a confluence zone made up of several things: horizontal support, a deeply oversold MACD, a fake out breakdown, lower low, coupled with a bullish breakthrough to the upside. If that all sounds too complicated, I can guarantee you I'm literally looking at three things. And all of that gave us a wonderful opportunity to get long Goldman Sachs and trade it into the 190s. Hope you can see how all these things are coming together, and it's very straightforward, and you can do this all day long, but it's important to notice these things because in a straightforward bull market, you will not get many of these moves. It's just going to be boring, trickling higher, and there'll be some of these bullish reversals and things like that, but it's nowhere near going to be as visually obvious and as explosive for profits as what we're going to have probably for the next 12 months. Let's look at one more stock. Let's look at Apple. Apple, I played on the short side. Apple, we all know Apple, very, very large. In fact, it's the largest stock in the world by market cap. For sure. So again, what we're using here is a couple of very simple things. We're using a 200-day moving average. That's that red line once again, and you can see when you can see how long the 200-day held for Apple. Basically, ever since it broke back above there in 2013, it's been acting as support. Apple then basically separated itself too far from the 200-day moving average until this summer it broke below the 200-day. What did we do? Once the stock broke below the 200-day moving average, which happened right here on this day on August 3rd, in fact, there were ominous signs before that to do this. But what we did is we had a confluence support zone that quickly broke and gave us a really high probability trade to get short Apple either via options or via the stock itself. So let me show you how this looked like. Let me get rid of a couple things just so you guys can see. Again, let's get rid of the MACD. I don't want to have too many things on here that you don't need to have. So you can see on this day, we broke below the 200-day moving average for the first time in a couple of years. We also managed to break below a horizontal line that previously acted as support. So if you look closely, what happened is that we broke below the lows that were set in July all in one swoop. There were signs that this was going to happen, and I actually went short a few days before because we had a triple top as well, okay, or a quadruple top, where you can see that this stock really tried to move higher, and it managed, and it didn't, and it never managed to actually break higher. So the path of least resistance was to the downside. The point is we had a confluence support area made up of horizontal support, the 200-day moving average, and an ugly candlestick. All of that quickly flooded the stock lower, and we had a wonderful opportunity to make some really good trades. And I'm currently, in full disclosure, I'm short Apple once again for a trade as of yesterday. So again, I'm not bearish on the stock or the company through a long-term lens, but I think the stock here is facing a little bit of uphill battle, at least for a few days or a couple of weeks or something like that. Again, we're having a confluence resistance line for those that care. The confluence resistance that's taking place right now is once again the 200-day moving average, which is in red. We rejected that last week. We are now working on what I call a rising wedge pattern, which for those of you guys that aren't so familiar with technical analysis, is a very straightforward pattern. It basically just means that we essentially had an oversold bounce that is getting the stock right back into a confluence resistance area that's made up of a lot of things, right? It's made up of the 200-day moving average in red, lateral resistance, and the upper end of this wedge. So the natural course of action for the stock now is that it goes a little bit lower, and I don't know how far. We have to trail this, but I think $100 or $110 is my first price target, and then we'll see for there. Yes, someone's saying that's a wonderful short-term play in Apple. It is right now. I think this is a pretty good trade. And of course, if Apple has a real quick bullish reversal in the next few days, we will get out. But this is a pretty good trade to do right now. I'll give you guys one more example in the S&P, and then one last example, and then one example I'm currently looking at as well. So you guys see how this is all working out with straightforward confluence support areas. So look at this. We're having here's the S&P 500 again. I'm using a 200-day moving average. What you see is once it broke below the 200-day on this day, it broke down there so severely that it not only broke the 200-day, it also really quickly broke a really clear support line that we had all year. It also quickly separated and broke below its summer lows all in one day. So you had three things taking place all in one day, giving us a really clear sign that this index is going to go lower. So we went short the S&P 500 and made a lot of money very quickly. Last thing I'm going to show you is Citigroup. Look at Citigroup, guys, today. Citigroup today had what I call a bearish outside day. This is what you have, this sort of engulfing day took place today, where the stock essentially engulfed the entire price action for the past few days, and all of this is also taking place at a Fibonacci retracement area that's almost exactly 61.8%. If you guys don't know what Fibonacci stuff is, it's very simple. But in this case, the move down and then the move back up measured this 61.8% Fibonacci retracement area, and this is exactly where we're getting this bearish engulfing candle. So I think Citigroup here is actually pretty interesting trade on the short side. So you can see these confluence support areas are really powerful things, support or resistance areas, I should say, as well. And that's something that I think everyone needs to be aware of to make money in this market here. I want to give you guys the Thanksgiving trade in just 1 second, but before we do that, I want to go through and show you guys the package I have on special today. If you guys are interested in learning the confluence zone and the support and resistance areas that I just showed you and all those really highly profitable trades that I just showed you, I'd encourage you to sign up for the introduction package, which includes a 30-page ebook, and it's a series, a video course, a lot of single 15-20 minute videos and nice segments where I explain all these confluence, support, and resistance areas in great detail. That is usually $199. It's just $97 today. So the code you need to use for that is EOAI. I'm going to quickly type this code and all the other codes into the chat room so you can see, or into the chat box here. So this is package number 1. Then package number 2, if you are interested in learning all these confluence, support, and resistance areas, including if you want 6-month access to my trade alert and analysis, where every single day you get a morning video, you get real-time trade alerts and analysis on a daily basis as well. That is usually $559. I'm going to offer it you guys for just $268. I'm going to put that link into the chat box as well. And the third option is if you want the ebook and online course plus 6 months of the Steady Trader trade alerts and analysis and daily morning videos, including some personal coaching, that's usually more than $1,000. I'm going to offer that to you guys today for just $508. And the link for that is the third I'm going to paste in here. And then you can pick your options there. Again, the introduction package basically teaches you all the confluence, support, and resistance areas that I just went through with all those really juicy examples that we'd made a lot of money on just in the past few months in the energy sector, in Facebook and Goldman Sachs and Apple and the S&P 500. And I think also we're going to make some good money here in Citigroup and again Apple. And those are the couple of the current trades that I have open right now. So the confluence, support, and resistance areas are in great detail described in this introduction package. That's just $97 right now, usually $199 today, just $197, using that first link I just popped into the chat box. The code is as you see here. You can also call the phone number down here, 1-877-440-9464, and my folks will be happy to answer your call there and take the order. So that's that. If you're also, and on top of learning this in great detail, these segments, you also also would like to actually get real-time trade alerts and morning videos where I show you these things, these confluence, support, and resistance zones taking place every single day, then the second package is probably what you would like. Again, it's usually $559. It's just $268 today. And the third package also includes coaching. That's usually more than $1,000, and it's now just $508 for the offer today. So if you've got any questions on this, please let me know. I'm going to quickly go to the Thanksgiving trade that I promised you guys on Twitter and elsewhere that I would go through. The Thanksgiving trade is actually very straightforward, guys. Okay, what the Thanksgiving trade is there's a seasonal pattern. There's a seasonal pattern to the Thanksgiving week. A lot of, and it makes sense. So basically what we have is we have seasonal strength in the stock market the week of Thanksgiving and the following week. It's not always like that. Nothing always works out, but a lot of times this trade works out. So what you want to do is you want to buy the NASDAQ 100 or the S&P 500 in this year's terms on November 23rd, maybe even on the 20th of November, which is the Friday before. You want to then sell it about 11 or so days later. And it's just a nice trade to do. Thanksgiving week tends to be quite slow in the markets. Everyone knows that as of Wednesday, people are basically done for the week. And it makes sense. But there's a saying out there that goes that never short a dull tape. And what happens is a lot of people are basically absent, not in the markets. We do have the Black Friday numbers. So CNBC and other guys can be very busy at the mall talking about the latest shopping statistics. But at the end of the day, what happens is there's just not enough market participants to really push the market lower. So what we tend to see is a slow drift higher. So it makes sense from a psychological perspective as well. So this is a nice trade for some Thanksgiving shopping cash. Of course, again, there's no guarantee that it works out. It doesn't always work out, but a lot of times you see a market that slowly pushes higher in the Thanksgiving week, including a few days into the following week. So I hope that makes sense. Now, I'm happy to take any questions. Again, I'm happy to do the Q&A right now, guys. Please go ahead and enter your questions. Again, if you're interested in in what I have to offer here today, the introduction package essentially teaches you all these confluence, support, and resistance areas in great detail, very high probability, so you don't have to stare at charts all day long. You can look at a few things and then basically just go ahead and execute these trades and active investments, because let's be honest, most people don't want to be sitting in front of the computer all day long, and these confluence, support, and resistance zones are so important in this market that we entered arguably in the mid part of this year already, and a lot of people still don't realize that. So I would urge you to take advantage of that. Again, the link, this is the first link that I've typed into the chat box. That's that introduction package. The video course and 30-page ebook is just $97 today. It's usually $199. Any questions, guys? I'm happy to take on any of the material I just covered. Bert was asking, are bond yields tied to the Fed's decision on interest rates? So bond yields are tied to the Fed's decision on interest rates. The short answer is yes. Okay, it's a little bit more. There's more to the answer, to that answer. Of course, it depends if we're talking about short-term rates, higher long-term interest rates. But yes, at the end of the day, yes, they are tied to what they do for the most part. And TF was asking, what's the MACD setting? Yes, 14, 9, and 30. It's just the very basic stuff for this. I don't really tweak with this too much. It's very, very straightforward. You're welcome, Paul. Paul is saying that he appreciates the information. Charles is asking, so what do you do if you're not an options trader? So let me be clear. This is not something for options, or this is not something that you only do. What I'm telling you today, this is not just for options. Okay. This is not just for options. This is, you can, I mean, I show you the charts. You saw all the examples I just gave you just before. These are just stocks, right? Yes, you can use options to lever your bets, but these are stock charts, I'm telling you guys, or ETFs, and this is no brain surgery. These are very simple, straightforward stock charts. I show you the chart of Apple. I show you the chart of Facebook, of Goldman Sachs. These are all just stocks, right? So you can either buy or sell or short these stocks depending on the signal we're getting from the confluence, support, and resistance, and they're very obvious. When these confluence, support, and resistance come into place, guys, they're very, very obvious. Okay. All right, glad that helps out, Charles. And go ahead and pick up a copy of your introduction package there. I think it would do everyone a lot of good to learn these things in great detail, because this is not the stuff that you learn in a textbook technical analysis thing. This is stuff that I've traded at JP Morgan and other places. I've learned over the past nearly 20 years of trading. This is telling you the truth about technical analysis, basically, that what you read in a textbook isn't really useful. It's good to know, but it's not really applicable in the real world. You need to look at more than just a single factor model when you look at the markets, particularly when they get more choppy. Gerald's asking, can BPI charts be used to help with confluence determination? What are BPI charts? Can you just be a little more specific in that, please? And again, guys, you can go ahead and use the links that I pasted into the chat room for these packages. Bullish percentage index, yes. BPI represents bullish percentage index, yes. You can, you can definitely use that. There are a lot of things you can. My point with these confluence, support, and resistance areas is that it's not just something that you can probably look at 3-4 things and determine a really, really, really high probability support and resistance area. And that's honestly all you need to look for. You can use BPI. You can use another 100 different indicators. The problem is, or the reality is, that most of those things are only going to tell you more of the same of what you saw from the other 3 things. That's why, to me, there are a few key things I look for in the confluence, support, and resistance areas. And again, they're all really clearly detailed in these packages, in the introduction, the essence of active investing, the ebook, and the video course, and in the other packages, of course, as well. So it's really just a matter of of you looking at a few things. You can use another indicator if you like that indicator, the BPI. Hey, by all means, use it. Use it as further confirmation, by all means. Charles is asking if I'm the person that sometimes fills in for Sam Collins. Yes, I am. There's only ever been one person that's been allowed to fill in for Sam Collins over the entirety of his career, and that's been me. Very, very honored to be able to fill in for Sam Collins. So, anyway, any more questions, guys? Otherwise, we're gonna wrap it up here. Again, don't forget to pick up one of these packages. Again, if you guys want to learn how to use these confluence support and resistance areas, I would highly encourage you to take one of these packages. Again, just $97 for the introduction package, which includes a video course, 30-page ebook. If you also, on top of that, want the real-time trade alerts and analysis and morning videos that explain you these setups on a daily basis, then the second package is the one for you there. Again, I've typed in all the codes into the chat box. Bert is asking how much to get trade alerts after 6 months. So basically, it's just 6 months, right? So if Bert is asking I guess he's asking what's the monthly fee. The monthly fee for the trade alerts, I think at the moment is $59. So you're getting a really good deal with this. Charles also asking what is an ebook. It's basically we will be sending you a PDF, like it's like a PDF attachment that's about 30 or so pages long with detailed description of all these setups, and it's sort of your guide along with the video course, so you can have something as well in your hands, if you will. Okay. All right, guys, I hope this makes sense. I'll stick around for another couple of minutes, but we'll wrap it up here. If you want to call in the order by phone, 1-877-440-9464 is the line you want to call. Otherwise, all the links are in the chat box. And I hope you enjoyed the presentation as much as I did. I think we're really interesting times here at the markets. So let's see what the market brings here into year end. Paul, I'm gonna do a couple more questions here. Paul's asking, do stops need to be wider in this environment? Yes. Yes, they do. And it also means, in my opinion, you reduce your position size at the same time. Gail's asking how long will the offer for? The offer will expire tomorrow. And then they revert back to the normal prices. All right, folks, thank you so much for joining. Have a great rest of your Wednesday and happy trading.